Hi, and welcome back to the essential training that we're doing here on Bollinger Bands. We're getting into class number 2, which means we're going to start talking about some indicators that are specifically derived from those Bollinger Bands. Specifically, we're going to talk about the percent B oscillator, the bandwidth indicator, and then we're going to look at pulling it all together. And of course, we'll wrap it up with some homework. So let's kind of do a quick overview, and then we'll look at some of the individual indicators. Whenever John Bollinger started working with these Bollinger Bands, what he discovered is he said, you know, there's some indicators that we could take from this information as well. And so these indicators we're going to look at are direct derivatives of those Bollinger Bands. If you compare that with, say, a traditional indicator like what we learned about in the foundations of stocks and options, you remember most of those indicators are going to take their data from the direct price information of the stock. That's what the Bollinger Bands do, but these indicators are specifically taking their information from the data presented in the Bollinger Bands. Now, there's two that are very popular. These are the two original ones. It's the percent B indicator and the bandwidth indicator. There's an additional suite of indicators that John Bollinger has created. They're not overly widely available. If you go to your generic charting software, you're probably not going to find some of his more advanced indicators that he's developed. And some of them are very niche. They look at some very specific components of a derivative of the Bollinger Bands. But these particular ones, the percent B and the bandwidth, you're going to find in most of your modern charting software. They're easy to use and they give some very good insights. And so let's start looking at these indicators. So let's start learning about the percent B oscillator. Now, you should have a pretty good idea of what oscillators are if you've been through the foundations of stocks and options. And the percent B oscillator is going to be very similar. Again, the difference is that it's taking that information as a derivative of those Bollinger Bands. Let's learn about it here. This is an oscillator based on the Bollinger Bands, and what it tells us is it specifically tells us where we are in relationship to the Bollinger Band. Now, this is a little bit different than some of the other formulas that maybe you've seen before. When you think about oscillators, usually you're thinking about oscillators telling us where we are in relationship to the stock. What this oscillator is going to tell you is where the stock price is in relationship to the Bollinger Band. And what's great about it is it gives us signals like you're used to seeing with your typical oscillators, with your RSI, with your stochastics, but it's doing it from a totally different calculation and different formula. Let's take a look here. Notice on this chart here of Exxon, if you see you obviously see the Bollinger Band here. And as we push into the lower band, as you see over on the left side of the chart, notice the oscillator is way down here at the bottom because that's the reflection of where we are relative to the Bollinger Band. And then as we start to pull higher inside the band, you notice how this oscillator starts to come up as well. Then we get to the top of the band and the oscillator is back up here to the top. And so you can see the benefit that we have here. What it's doing is it's starting to plot along that oscillation factor, kind of that sine wave that you're used to seeing with oscillators. It's plotting it, but it's based on, of course, the relationship there to the Bollinger Band. If you look back at the same chart, if you look, as we cycle down here to the bottom, we're back at the oversold conditions, and we cycle up and we get into this trend, and we're back up here into overbought conditions. And then something you're going to notice here, look here, we make a higher high and then a higher high, but look at your oscillator, it's making lower highs. There's that coveted divergence. And that's one of the great signals that we do get here with the percent B. Percent B gives us very solid signals like you're used to getting with, say, for example, your RSI or with your stochastics, but again, it's going to be put inside this framework of the Bollinger Bands. Divergence in particular is one of the signals that's really, really good at giving us. So let's take a look over here at a few data points. When we think about the formula for the percent B, the formula is actually a formula that you might be familiar with. Here's what it looks like. It's the last price minus the lower band divided by the upper band minus the lower band, and that equals the percent B. Now, if you are familiar with stochastics, you're going to recognize that this is actually the same formula that is used to calculate the stochastics, but instead what Bollinger's done is he's taken that and he's applied it to the band. So he's replaced the last price for the end time period, and he's just altered the numbers a little bit here, but the formula itself is just the exact same formula of what we would typically use to calculate a stochastics indicator, but instead, again, we've applied it here to the Bollinger Bands. Now, let's talk about some of the range definitions. You know, it's really important when we understand oscillators to have an idea of what that range is. If you remember back to your Foundations of Stocks and Options training, you should remember that oscillators typically come in two forms. You've got a range-bound oscillator that's going to cycle between 0 and 100, and then you're going to have a non-bound oscillator that's typically going to cycle over what we call a zero line. For example, the MACD oscillator is a zero line in the center there. It's a non-range-bound oscillator. Well, the %B is kind of a hybrid there. It's going to look like it's the RSI or the stochastics. It's going to oscillate the same way, but it's not got a definite range to it. It has a definite high and a definite low, but it can move outside of that. And in fact, when we move outside of that, we're getting outside of that standard deviation. We see that reflected there in that %B. Let me show you how the formula works here. %B is not range-bound. In other words, there is no definite end to it, but there are definite settings, and here's what they look like. If we are greater than 1, then the stock is reading above the upper band. Now, what does that mean to be reading above the upper band? It means we're outside of that standard deviation, so it's relatively speaking quite high. In fact, it's way too far away from the average of what we've been trading at. So whenever you see a reading above 1, you know that you're going to be, relatively speaking, rather overbought on this particular trade. Now, if we get down to 1 itself, if the %B is reading right at 1, then the stock is right at the upper band. And if we go to 0.5, then we are at the middle band. If we get down to 0, then we're trading at the lower band. And if we're below 0, then we're very oversold because we are below the lower band, meaning we're on the opposite side now. We're beyond the standard deviation, below where we should be. So let's come over here and let's take a look, and I'll show you a couple of examples here. Notice right here we're well below the lower band, and look how oversold we are on the oscillator itself. Then what happens? Immediately the trade has to go sideways for a little bit here to get back inside the bands. Now that we're back inside the bands, the trade can continue, but before you know it, we're back outside the bands, we're oversold again. And once you start to see that, you know that you can't sustain this very long. And so certainly, very quickly here, the trade starts to go sideways, and then ultimately we start to have a reversal here. So now let's take a look at the next point. If you notice right as we are at the band itself, you see we're right at the band here, and look at how the oscillator is right at 0. And so that's the way that's going to read. Now if you move over to the middle band, as we're crossing up into the middle band, the oscillator is reading right at 0.5, which is right in the middle of the possible range. If you wanted to put some other ranges to this, you could call 0.5 the 0 line. That's the way a typical non-range-bound oscillator would work. It's just that we've titled this 0.5. That's the value that they've assigned to it. But it's still the principle of the 0 line that you're oscillating around. And then if you cycle up here to the top, notice right as you're at the upper band, look at how, well, this closing price was a little bit below the upper band, but right as you're up at the upper band, you're up towards the 1 reading on the oscillator. We bounce back down here to the 0.5, or back to the middle, I should say, and we're back at 0.5. Now, if you come over here to the right side, notice the extremes that we've got. We've pushed well beyond the band here, and we're above 1, so that becomes a very overbought reading. And so immediately, I mean, usually it's within a day or two, when you're that far outside of the band, usually within a day or two, this thing's going to at least correct a little bit to get back inside the band. And then notice right here on the far right side, we're closing right on the upper band, and look at the oscillator. It is right on the 1 reading here of the %B. And so the settings are pretty straightforward. It's pretty easy to understand. Once you've looked at it a little bit, the interpretation is not really that odd. In fact, it's quite straightforward. Again, it's kind of a synthesis of that idea between the MACD that does not have any range bound to it, and the stochastics that is going to be range bound. And again, it's also built on that stochastic formula. Now let's talk about the signals that we get with %B. With %B, there's a couple of signals that really matter. All oscillators, as you should know, are going to reflect typical overbought, oversold settings. Percent B is no exception. And then the additional one that you're going to see with percent B is divergence and convergence. These are going to be the two signals that we primarily get with percent B. They're typical oscillator signals that we're used to seeing with your RSI, your stochastics and whatnot. And it's just giving us the exact same signals, but again, the formula of how we get there is derived from those Bollinger Bands. If I come over here and look at a chart here with Exxon, you're going to notice a couple of examples that we just had. As we push outside the upper band, look, we're very overbought. Now the next thing that happens is we keep pushing up into the band, but notice we're not outside the band. We're kind of slowing down a little bit. And look at your oscillator, it's going downhill. There's your bearish divergence. And so what happened following the bearish divergence? Well, it turns out that Exxon started its reversal here. Now, look at the one over here on the next little bulge that you've got going. Look at how we've pushed outside the band. We're very oversold. And we keep pushing outside the band. We're still oversold, but it's not at the same rate. And then, of course, that leads to the next move. This is a typical type of divergence that you might see with percent B. A lot of times your divergences will line up with a double top or a double bottom or an M pattern or a W pattern. Sometimes it will look like this right here, where inside the trend itself, part of the trend's pushing outside the band, part of it's not, and you see that slowdown in momentum. You start to see that divergence, and that oftentimes will lead to that reversal that you're looking for there. Now, that kind of sums up all your basic principles of the percent B. Again, it's your typical oscillator principles, it's your typical oscillator signals, but it's taken from the Bollinger Bands. The next one we're going to look at is your bandwidth, and we're going to see how the bandwidth can play a major indication in terms of what's happening with the spacing between the bands. So now let's talk about the bandwidth indicator. Now, the bandwidth indicator is very interesting because it gives us a reflection, kind of like an oscillator, but it's showing us the width between the bands. Here's how it's going to work. It's going to measure the distance between the upper and the lower band. In other words, it's telling us how wide that spacing is. Now, there's going to be two real signals that you get. You're going to get the squeeze and the bulge. During a squeeze, your bandwidth is going to be very low because it's reflecting that low volatility. It's tightened down. And during a bulge, your bandwidth is going to be very high, again, because that volatility has come in there. So let's take a look over here, and I'll show you what I'm talking about. Notice across the bottom here, this is your bandwidth indicator. And look at your squeeze. You see how tight the bands are here? And look how low the bandwidth is. Now, it seems like it's kind of an obvious signal, and it is a relatively obvious signal. I mean, you can kind of get the same data just by looking at the bands, but this is an interesting way to present it. It also provides some interesting opportunities for scans and whatnot by just simply scanning for bandwidth readings. So take a look over here as we get into the bulge. Notice how your bands have started to separate out. This is a bulge, and look at your bandwidth indicator as it's continuing to go higher and higher. So what you can see here is when you've got a squeeze, the bandwidth will start to tick higher as the squeeze is expanding there. Then as you get a bulge, if it's going wider, the bandwidth will keep going up, but if it starts to contract a little bit, the bandwidth will actually start to come down, and sometimes it will start to come down before you would even have normally seen that in the Bollinger Bands themselves. Come on over to another example on the same screen here. Here's a picture of your squeeze. You see how small the spacing is. You see the bandwidth and what's happened here. And then, of course, that expands into a bulge. Now watch what happens on the right side of this bulge here. Look at how the bandwidth starts to drop off quickly. And look at what's happening with the stock. In this case, the stock is starting to go flat as those bands are starting to contract and show that this massive movement in volatility is coming to an end. And so that's the benefit, and that's kind of the general idea here of what the bandwidth indicator is going to do. It's going to show those expansions and those contractions on more of an oscillator type formation. And then, of course, we can use that for a lot of different things. One thing a lot of people like to use it for is for scans. They scan and they say if bandwidth is below this percentage point here, then those are the kind of trades I want to go look for. Again, because the squeeze would be coming up. So here's your formula for the bandwidth. The bandwidth formula is really straightforward. You simply take the upper band and the lower band. You subtract the lower band from the upper band, and then you divide it by the middle band. So whatever the upper band's doing, whatever the lower band's doing, you do the subtraction there to get the differential, and then you subtract it by the middle band, and that tells you the width of what's happening with those Bollingers during that time. Now, there's a couple of signals that we get. The two main signals are going to be the squeeze and the bulge. Of course, these are the two kind of primary signals you get with the bands themselves. The bands contract and the bands expand. Naturally, those are going to be the two signals that you get with the bandwidth indicator. Now, let's look at a few distinctions with each of these. With the squeeze, here's what's going to happen. It's going to be a low point in the bandwidth, a very low point here. It's going to reflect contracted volatility. The movement of the stock has contracted and it's not moving quite as much as it used to be moving. It's forecasting an increase in volatility, and this is a really, really important point right here. The reason you want to find low bandwidth, the reason you want to find squeeze opportunities is it's forecasting an increase in volatility. Of course, that's where you're going to make your money as these non-volatile moves turn into volatile moves where there's a lot of movement happening. Another way of looking at this is when you see a squeeze, when you see a low bandwidth, it is the beginning of something. That's a really valuable way of thinking about this. The squeeze is the beginning of something. The bulge is the end of something. And so you've got the squeeze and you've got the bulge. The squeeze, low volatility, low bandwidth, and it's the beginning of something big that's about to happen. Now let's take a look over here at a couple of squeezes. This is back on the Disney trade. Notice how tight that squeeze was. Notice how low the bandwidth was. And of course, what happened? Well, the stock broke out and we had a 15-point move in just a couple of weeks here as the stock started moving bearish. Now, if you come on over to the next squeeze that we had here, the really solid squeeze, low bandwidth here. Of course, as it breaks out, this one happened around earnings, but again, we had a pretty good sized move, another $15 or $20 move that happened in just a couple of weeks. Now, we had a couple other small bandwidth areas. Here was the low point, and this was a squeeze that did break bullish, but it started to kind of oscillate in here, and this would be a good time to look back at your percent B and see how that oscillation was playing out there with your percent B. So that's how the squeeze starts to show up here in the chart. Remember, the squeeze indicates that something is about to break loose. It's a really important concept to understand. When you see the squeeze, when you see low bandwidth, you know it's just a matter of time before something breaks loose. It cannot stay that low for a prolonged period of time. All right, now let's look at another example over here. This is on Halliburton, and I want to show you on a very solid trend how the waves of the trend are kind of fleshed out here with this picture. That's another important concept to understand. When we have trends typically move in waves, or another word that's often used as legs. There's a first leg, a second leg, or there's a first wave, a second wave of the trend. And those trends will typically run up and then sideways and then up and then sideways, or they'll run down and then sideways and then down and sideways. We see that being diagrammed very clearly here with the Bollinger. So take a look at this Halliburton trade. This was a long bearish trend. Notice we had a low bandwidth, we had a squeeze that was happening, and it starts to break below the band. It starts to break bearish. We had a very sudden surge of movement here. It's about a $15 move. Look how big the bandwidth got. And again, this was expanding for the volatility component there. And as the bandwidth said, okay, I'm done, and it starts to cycle back down, what happens? The stock moves sideways for about a month. Then what happens, the next thing, we got a squeeze, it starts to break bearish. As bandwidth gets really large, again, it starts to move sideways and the stock gets stuck. Then we get into another squeeze that actually stayed really relatively tight for quite some time. It moved on up eventually, but it did take a while to get there as we were forming a base here with Halliburton. But again, the idea is you recognize the squeeze, you see the bulge, you recognize the squeeze, you see the bulge. Another important thing to understand, and another idea, is you can look at relative levels. Remember, everything with Bollinger is quite relative. So you look at this Bollinger bandwidth indication down here, and you can kind of start drawing areas where you say, whenever I get down to this area, it's about as tight as it's going to get. You can look at the highs and say, whenever I get up to this area, it's about as high as it's going to get. So that's going to be the extension of those bands. That's going to be extension of the bulge. When you start to get that wide, you know it's not going to keep going that much longer, because relatively speaking, we're kind of overbought, if you will, or overbulged on this bulge that's happening here. So that's another way you can look at this information. Now, speaking of the bulge, that's the second signal that we get. The first one's the squeeze, the second one is the bulge, and here's what the bulge reflects. It reflects a high point in the bandwidth. In other words, the bands have expanded really, really wide to help encompass some of that volatility that's come in. This is going to reflect expanded volatility, and here's the key. It's forecasting a decrease in volatility, also the end of something. If the squeeze is forecasting the beginning of something, the large bulge is forecasting the end of something, because again, it just cannot stay that volatile for an extended period of time. Let's take a picture over here and notice this is the same chart here on Halliburton that we just talked about. We were so high on the bandwidth here, it had moved so far bearish. And also, if you were looking at the percent B, you'd see we were way outside the band here. You know this is unsustainable, and certainly the trade moves sideways. Now, if you're a stock trader, if you shorted this stock, you kind of don't care. You can just hold it. But if you're an options trader, this is gold for you, because it's telling you this is the surge I'm getting into, and once that surge is done, I'm out of the trade. And when you're dealing with that time component that we deal with when we trade options, this is a very, very valuable insight. Look at the next one over here. Again, we had the bearish gap down here, pushed outside, and look at how the stock slows down. Bandwidth was huge, and as the bandwidth starts to fall off, the stock stops its falling there, and that volatility is coming out of the trade. So that's the way these squeeze and bulge pictures are going to show up here on the bandwidth. So let's take a look here at this Halliburton trade, and let's add now the percent B with that bulge. And notice what's happened. So you've got your bandwidth, it's starting to come down. You've got the stock starting to slow down, it's starting to go sideways. And look, we've got lower lows and higher lows. There's your bullish divergence. This happens so frequently. You get a bulge and your bandwidth shoots up, then as your bandwidth starts to come down, you get that divergence. It is a very, very valuable signal. It's telling you this is the end of that leg, the end of that wave, whatever it is that you're dealing with. It may or may not be the end of the trend, but certainly the end of that surge of energy that has happened at that time. And as a stock trader, maybe you don't care, but as an options trader, you really care a lot, because you don't want to be stuck in that time component where you're holding through those little corrective moves. So this is a very, very valuable signal, and it's very much worth your time to learn to recognize it. So what we've learned here is we've seen how the percent B and the bandwidth work together. You understand how each of them work a little bit. What I want to do in the next video is I want to show you how we can start pulling it together. Take the percent B, take the bandwidth, and we add it in here with the three main plays that we learned about back in the first lesson, so you can start pulling it together as part of a system. Now that we've talked about the percent B and the bandwidth, let's talk about how we pull it together and start to lay the foundation for a trading system. So, do you remember the main plays, the first ideas of what we use whenever we're talking about the Bollinger Bands, the squeeze, the trend trade, and of course the reversals? Well, what we want to do is we want to start looking at how these indicators can impact each of those plays. These indicators add signals to the main plays. So let's look at first the squeeze play, then we'll look at the trend trade and the reversal play here. With the squeeze, what the bandwidth does is it tells us when the squeeze is coming. And so this is one of the keys, is you're going to use the bandwidth to tell us when the squeeze is coming. Of course, you can see the squeeze coming, but the bandwidth is a way that you can scan for it, or if you want to just quickly look at it, relatively speaking, and say, okay, you know, high or low, bandwidth is really low, so I know that there's definitely a squeeze that's coming here. It also shows us the squeeze is breaking out. As the squeeze starts to break, you're going to see the bandwidth start to turn up and show that expansion there, so that will also be an indication that you can get here with the bandwidth. And again, as I've mentioned a couple of times, bandwidth is a great criteria to scan for to go find some of these squeeze plays that might be out there. Let's take a look over here and notice we're using all three of them here. And by all three, I mean the percent B across the bottom, the bandwidth, and then of course the Bollingers on top. Notice we've got a great squeeze that happened here on Alaska Airlines. You see we were very low, and it starts to take off here. Also notice what's happening. We're way outside the band, and we're very overbought. This is very typical. Whenever you're looking at a squeeze breakout, usually the first signal you're going to get is a bit of an overbought or an oversold signal on the percent B, because very often when that squeeze is breaking, you're going to be outside of the band, at least for a couple of trading sessions there. And so that's exactly what happened here. We get to moving here, then watch as the bandwidth starts to turn down. This squeeze has run its course here, and this particular move is done. You're also noticing there's a strong divergence that's happening across that move. So pretty much from the time the squeeze starts to the time it ends, you're going to start to see that divergence, and you're going to recognize that's happening there. So you're looking for the exit signal. The divergence itself is not an exit. It's just showing you that that momentum is starting to slow down. That first surge of energy came from that breakout of the squeeze itself, of course. If you look further over here, maybe into the beginning of January, you're going to notice another squeeze that happened. Look, there was the low tick in the bandwidth, and then it started moving up from there. And as it starts moving up, you start to see that breakout starting to happen. The trend was very slow getting going, and then finally it surged out here. And once again, the bandwidth peaked, and it started to tick down. But if you look over to the far right, now what's happening? We're getting back into another squeeze type of a scenario. So more often than not, when you see the squeeze, it is an indication that something's about to happen. And what's great about the bandwidth is visually you can see very quickly, yep, that squeeze is getting into place. I often get emails, I get screenshots from people, they say, is this a Bollinger squeeze? And there's some question about it. The bandwidth indicator is really the best way to see that, again, because of the relative nature that you've got. Sometimes, you have a squeeze, and for some stocks it's a really, really tight squeeze. And for some it's kind of, it's a tight, but it's not that tight. Well, you may wonder, but if you look at the bandwidth indicator, you can look across the board here. Look again, and you see, yeah, I'm down here, I got a squeeze. I'm down here, I got a squeeze. I'm down here. And so you get a good relative idea. Maybe on, for example, Alaska Airlines, the squeeze is coming in at 4. That's the reading that we're getting here, 4.1. Maybe for another stock, the squeeze starts to show up around 6. Maybe for another stock, the squeeze starts to show up around 3. So you can look relatively from stock to stock, and you can say, okay, where does this stock typically start to set up that squeeze? And you can start to set some perimeters on that. Of course, the percent B is just giving you some additional information as you see across the bottom. So let's take a look over here at First Solar. Let's start by looking at the far left side of the chart. And you see this squeeze, and look at your bandwidth indication. Look how low it is. It's actually right around 5 on the bandwidth scale here. And of course, that got into a really nice move. It was about a $20 move as the First Solar trade broke to the downside. And look at what happened to your bandwidth. It moves really, really high. Relatively speaking, it's very high. And then, of course, it starts to tick down, and that move is done. Now, let's compare that to, say, the middle of the chart here. In the middle of the chart, you do have a tighter band. It's a much more contracted picture. But if you look at your bandwidth, you realize this is reading up here around 7 or 8, so it's not nearly as contracted as the one that really broke out nicely back in September. And so you can see that picture here, and you see that in the bandwidth. You don't see that on the bands themselves. With the bands themselves, they both look like contractions. They both look like squeezes, but on the bandwidth, you can see the extent to how tight it really has squeezed down. Now, if you come on over to the right side of the picture here, you're going to see a really tight squeeze. This one's actually even lower than the September squeeze, and it took a little bit of time, but it did start the breakout, and then once it started to break out, looky there, there's your head fake, and of course, this trade has moved to the opposite side, and it started a bearish trend, even though it started with a bullish breakout. That's that part of that fake out trade that we've talked about a couple of times. But the bandwidth is a very good indicator to help you understand better and to see visually better where the spacing is for those squeeze plays. And of course, that's the beginning of the big break. Let's do one more example in here, and this one's of the Aussie dollar against the U.S. dollar. Notice as this trade's coming out of a large expansion, we got a pretty good size move here with our bands, and then we get the contraction here, and look at your low bandwidth that comes in. Now this low bandwidth, if you look to the far left, you can see it's not quite as low as the previous one, but it is still pretty low, and look at how it plays out differently. Yes, this was a squeeze that turned into in this case, a trend trade. Look at what happened though. It broke bearish, and then it starts trading the trend trade, walking the band down through here, cycling between the middle and the lower band. Now compare that with the one that we had before. You'll often see this, by the way. With the one we had before, back in September, we had a very, very tight squeeze, and when it broke out, it was more like a surge of energy. This one that we had here between November and December was a little bit more orderly, and oftentimes when you see a squeeze, but it's not as tight, the move that follows is a little bit more of an orderly move. When you see a really, really tight squeeze, with very rare exception, that breakout is usually a much bigger burst of energy. That's why you kind of want to figure out what kind of a squeeze you're dealing with here. Take a look at the next one that we had here is a really tight squeeze. Again, it was kind of similar to the November one, but it broke out more similar to the September one. Very fast surge of energy, and it stopped very quickly here. And you can see the bandwidth, it surged and then it ticked down. And then, of course, the trade got to moving very sideways during the next phase here. Now, what's also interesting, sometimes these trades don't always play out the way you're thinking they will. Here's a squeeze that did not play out. Very low bandwidth. It played out bearish initially. I've used this one as part of our head fake example. We got the bullish morning star reversal candlestick formation, and immediately our target's the top of the band, and you see it right there. That's what happened. Traded back to the top of the band. Bandwidth started to expand, but it kind of stabilized in here, and you really ended up with more of a foundation than we did an actual big surge of energy. Still, it was an interesting trade, and still we could make money with this trade, a few hundred pips actually on this trade, but it didn't have the same kind of surge of energy as maybe you would be hoping for from a squeeze. It's another thing to really bring back to your attention. You know, whenever we see squeeze plays, the excitement is always that, hey, this is going to be a windfall profit. I'm going to see a big, huge surge of volatility. And oftentimes, there's still money there, but you've got to really learn to play it because of that head fake. The head fake happens more often than you want to admit. And so what happens is you have the squeeze, it breaks out, and then it head fakes. If you take that counter trade really quick, you can oftentimes make a really good chunk of money. It's not the chunk you were expecting to make, but it's still a really good chunk. And this is a great example of where we still could have made money on that trade if you'd recognize the head fake that was happening to us. Now let's look at how these percent B and bandwidth indicators help the trend trade. So understand the bandwidth adds clarity to not just the squeeze, but also to the trend trade, even without the squeeze. How does that happen? Well, oftentimes what will happen is the bands kind of get established in a range, and then they start to expand. Even though there may not have ever been a squeeze, that's usually going to be the precursor to the trend trade. The bulge tells you where the trend is likely to be ending here. This is a really valuable signal that you get. And then, of course, the percent B is very valuable in the trend trade in terms of showing you the divergence and the overbought and oversold. But really, the divergence is the one that really tells you the end of the trend trade. So here's the signals we get. Let me kind of put it on a bumper sticker. We get some insight that the bands are starting to expand as part of the trend trade. We really get insights when the trend trade is ending, which is obviously a very, very valuable signal to see. Take a look over here at DuPont and notice the bands are starting to contract, but we're far from a squeeze. I mean, look at the bandwidth relativity. We had a squeeze earlier. It was very, very low bandwidth. We're not even halfway back to that point yet, but we are getting ready to establish a trend trade. And if you look at the trade itself, notice this trade's getting established inside the bands for a trend trade. We had a dip down here, back up basically inside the bands as part of the trend trade, back up inside of the bands as part of the trend trade. And so this happens, but what will confuse people is they think, well, there's no trend coming because I didn't see a big squeeze. Well, look at what's happening. Look at how the bandwidth actually helped us here. As you're falling, I'm circling the detail inside the circle here. As you're falling, we see that the bandwidth starts to tick back up, and that's showing us that, oh, this thing is starting to expand a little bit. We actually did have a bit more of a squeeze here. There's your head fake right back into the trend trade. And then on the right side of the screen over here, again, you're pushing up into the upper band. Not really a squeeze, far from a squeeze that took place here. But you see how the bandwidth continues to tick higher and higher, supporting that trade. And of course, we see the ends of these moves when we see the decrease in the bandwidth. Let me point out a couple of those on this screen for you. Obviously, the big bulge after the squeeze, that was the decrease there. But if you come over here to the middle, look in January. This was kind of a move that was starting to get a little bit stagnant in here. And you notice how the bands started to contract, and it was really showing the end of that previous move. The other thing that you're going to notice in here is you're going to notice some divergences taking place with your percent B indicator in here. Notice we've got some divergence taking place between these two peaks. Not a huge one, but we have some happening in here. We really have a lot of momentum starting to shift here with this move. I'm going to put it in a square. With this move that's happening in January, and you see how the percent B is just coming back in basically to the zero line. in the inside of that move itself there. So this is some of the pictures you'll get. Let's take a look over here at another trade. This is on 3M. This is a very good picture of a couple of things. Number one, we did not have a squeeze, but it played out like a squeeze very similarly. You see the bandwidth clicking up here. And then look at the divergence that happened. This is oftentimes the way a %B divergence will look. It's not always the nice peaks that we're used to seeing with some oscillators. A lot of times it just shows that slow, steady decline pulling away from the band. Remember, the %B is showing where we are relative to the band. Look at this stock price. It's pulling away from the band. That is a reversal. That is not a strong signal. The more it pulls away from the band, the further it's getting away and less strength that it's revealing. So that's what you see happening with %B. So %B is ticking downward consistently, not showing the trade is done, but showing it's losing some of its momentum. And then, of course, we ended up moving back into a bit of a squeeze play here where we finally broke out into that. And then again, your %B down here showing you some of the cycle and the oscillation that's happening inside that move there. Let's take one more look here. This is a really nice clean trend trade on the US dollar against the Canadian dollar. Notice this almost looks like a squeeze. It's not quite a squeeze, but it almost looks like a squeeze. If we went back, you'd see there's a little bit better squeezing activity later, or earlier, I should say. But notice how this oscillation works. This is a really good picture of a couple of the oscillation ideas in here. Bandwidth obviously increases in here. We run up into the upper band. We're overbought. We cycle back down to the middle band. We make that turn back up, and you see how this is just literally oscillating inside this trend trade here. Now watch as we get outside the band, we're very overbought. We're right at the band, and there's your divergence starting to take place. Now this is going to be signaling the end of a trend trade, and that's one of the great signals that you get here with this combination of indicators, especially the %B. I really, I could live without any of these, but I like the bandwidth at the beginning of the trade with the squeezes. I love the %B at the end of the swing by seeing that divergence, especially when you can pair it up with a picture like this Bollinger Band picture mixed with this %B. You see that divergence there. It's just a really, really great oscillator showing you specifically with those touches to the band where that divergence is coming into play. You don't really get this divergence picture with any of the other oscillators. Now, while I'm talking about that, let me go a step further and say the %B divergences is not necessarily going to show the end of a trend the same way that a, say for example, MACD divergence would show. MACD will show the end of an intermediate trend completely. %B will be more the minor level trend, and it may really be indicating more of a sideways move coming than a full reversal, but it's still exceptionally valuable, especially as an options trader where you're trying to capture that surge of trade and then get out for the sideways moves. %B is really an invaluable signal that you can use for that, and I really like using it a lot. I don't typically teach it a lot because it starts to add up a whole lot of different indicators people are looking at, but secretly I look at this one behind closed doors quite often to get a perspective of where things are relative to the Bollinger Bands. Finally, the last play we're going to look at, coming back to the reversal play, and let me show you how the indicators can help you here. The %B is going to show us divergence. Again, you hear me talk about this all the time because it's such a great signal. It's going to show us divergence, and it's going to clarify some of the reversals. And then what's going to happen with the bandwidth is it's going to have the bulges, of course, that help clarify the end of the trend, which is going to be the first part of the reversal. So let's look at some pictures here. If you look at, again, this US dollar against the Canadian dollar trade, we were in a nice little swing, a really, really nice swing, several hundred pips worth of value that we got out of this. And then look at the top of the move, bandwidth starts to turn down. You've got the divergence happening with your %B. That is a perfect signal telling you, yep, we've run out of steam. This is what the reversal signal is really all about. This is the two signals coming together. You see this as a trend trade that's turning into the reversal. And typically they happen like this. A lot of times you'll have the squeeze turns into a trend trade, turns into a reversal. So you kind of have three phases of the trade that are really the three signals of the Bollingers. And so this is exactly what you're seeing here. We had not quite a full squeeze on the far left here, but a pretty tight move. Moved into that trend trade. Now here's the reversal. Now watch what's happening in here. You're seeing the bandwidth lead the way. The reversal picture itself is this M pattern or the double top that's starting to come in on the back side. In this case, the divergence was the first indication, the bandwidth was the second, and then the actual reversal formation started to happen several trading sessions later. So if you were waiting for the reversal itself, you would have been way behind what the indications were telling you with the bandwidth and with the percent B. Very good indications for helping show you the end of that swing. It really helps time the exit of the moves. Take another look over here at a couple of moves. This one happened on American Express. Again, the exact same scenario. I'm going to draw out the reversal first. There's your M pattern. Here's your bandwidth, which actually turned down early, way early in the pattern. And then here's your divergence that was happening between the moves themselves. And so again, the indications, the percent B led the way, giving you the first divergence signal. The bandwidth led the way, giving you the contraction of the bands, and then finally you got the full reversal signal that the Bollinger Bands are kind of known to provide for you. Let's take a look at a bullish version of this, pushed way outside the band, and then here is that little W pattern that starts to occur. Bandwidth had preceded that very quickly here, not by a huge percentage, but by a couple trading days. And from a divergent standpoint, you started to get it, but it was not as clear because it had surged so quickly and we didn't have nice cycles in there. If you have more of a trend trade, you'll see the cycles usually. But this one, you really got the divergence exactly in line with the reversal itself. So that did not help you quite as much from a forecasting standpoint, but it was still a very valuable signal to get. The point here is to show you how the percent B divergences will show up with reversal trade and how the bandwidth will start to contract or will turn down during the reversal play, which is oftentimes a precursor. Sometimes it happens exactly with the reversal, but in either case, however it happens, it's a very good confirmation that this trade is running out of steam and maybe you need to at least tighten your stops, if not completely get out of the trade and save whatever capital you've got there.
In this video, we're going to talk about setting up the Bollinger Bands in Motive Wave. If you're using a different charting software, then this video may not help you. It might help you get an idea of how they would set up in another software, but if you're not using Motive Wave, you don't need to necessarily watch this video. But if you are using Motive Wave or TSU charts, then here's what you want to do. So we're going to come over here into the Motive Wave application, and it's really simple to add indicators in here. Go up to the upper left menu item where it says Study, and click on that, and then come down to the one that says Overlays. And if you look at the overlays, you're going to come over to the right side, and you'll go down to the one that says Bollinger Bands. And it's that simple. You click it, and it's going to add it to your chart. Now, if you take a look at this little screen here, you've got some alternatives of different information you can put in. For example, you can change the period from, for example, 20 to, say, 14, if that's what you wanted to do. But we're going to leave it at the default of 20 with a standard deviation of 2. If you wanted to change it, the top one is going to be, of course, your top band, and the bottom period is going to be your bottom band. And then, of course, the standard deviation for the top and the bottom there. Some people like to shift the bands forward or backwards. I don't recommend that, but if you wished to do so, you could do that right here. Now, if you come down to the area where it says colors, this is where you can change the colors of your bands if you wish to change the color lines here. And then, of course, your middle band. And then you can also change the size of your band. I like to go with about a 2.0, so we'll do that here. And you can change the middle band or any of them from a solid line to a dotted line or a variation of dotted lines there. So the middle band here is set up as a dotted line. If you click on the little pencil, you can go even further into details here and change stuff around. Now, you notice this thing here, it says fill color. This is optional. Let me go ahead and create this. I'm going to hit create, and you're going to see the Bollinger Bands now created on the chart. Now, to edit this, there's a couple of ways you can do it. You can click on one of the bands, and it kind of bolds it, and you can double-click it, and well, that one pulled up the chart settings itself. If you double-click it just right, there you go, it will pull up that same box, that same window for you. The other alternative is in the upper left corner. You see where it says Bollinger Bands, or BB. you can double click that and it will pull up the same box. Either way, either method will pull up the indicator on your chart. Now, you see down here where it says fill. If you click on the display box, it will change this in here, and this actually creates a fill color. Now watch this. I'm going to hit apply and update, and you see that's how the Bollinger Bands get shaded in. Now, I think that's a little bit dark right there, so I'm going to come back in here, and I'm going to go down to more colors. And watch this, I can change the opacity down a little bit. I do like the shading. I think it looks nice, but it was a little too dark. So there you have it. We've applied that, and that's how you add the Bollinger Bands here in Motive Wave. Now, let's go one step further. Now that you've got the Bollinger Bands in here, let's save it as a template. And so to do so, let's go to the File menu in the far upper left corner and go down to Chart, and then go over to Template. And then we're going to go over to Save as Template. And when we do that, let's go ahead and name this, and we'll call it B-Bands Suite. And then we're going to hit Save As, and voila, it has been saved. Now if you come back to the File menu, Chart, Template, you'll see B-Bands Suite. You also see the key command Option 7. And so with Option 7, what happens is if you're on your regular template and you press the key command Option 7, it will pull up your template for the Bollinger Bands. Really easy to set that up here, and then once you've got it in there, it's set up as a template. So that's how you set the templates up in Motive Wave. Okay, in this video, what we're going to do is we're going to talk about setting up your Bollinger Bands for use in the charting software Trade Navigator. Now, if you're not using Trade Navigator, this video may be of no use to you, or maybe it will kind of give you an idea of how it gets set up in a different charting software, and maybe that will help you with your individual software. But let me show you how it works here in Trade Navigator. The first thing you're going to want to do is learn how to edit your chart settings. And the way you do that, the fastest way to do it, is to right-click with your mouse. So right-click on the screen with your mouse, and it brings up this little menu here. And just click on the first icon, or first item here, I should say, that says Edit Chart Settings. You see that? So we're just going to click on that. And when you click on that, it brings up this window right here. Now, this window is where you can make a lot of changes to your chart. The first thing you're going to notice is you're going to notice this section over here where you see pane 1. It says price, and there's some different things in here. If you go on down, you see pane 2, and it says ADX and stochastics. If I came down to, say, for example, pane 6, it says volume, you can turn that on and off, and watch what happens when I uncheck it. I check it off, and then suddenly the volume disappears. So what we want to do is let's highlight pane number 1, which is for price, and then we're going to come to the bottom of this window where it says Add. So just click on Add and go down to the one that says Add Study Pre-Built Pane. It's the first one. So we'll click on that, and it brings up another window here, and you'll notice about 3 or 4 down, you see an item that says Bollinger Bands. So click on that one and hit Add, and voila, it adds it to your chart. Okay, so the next thing we want to do, if you look at the way it shows up on the chart, it's kind of a little different than maybe you're normally used to seeing it. And so let's change these settings a little bit. The way you do this is, again, if you click out of here, then you right-click to come back to Edit Chart Settings. If you never left, then you don't have to do that. But click on the moving average line here, and in the upper right area of this window, you see an opportunity to change the color, for example, if you wish to do that. Just, maybe you want a softer color. You can change it from a line to, something else. It doesn't make a whole lot of sense to use steps or something other than a line for this one, but you could do that here. But look at the one that says width, and you see it says default. Let's change that to, say, for example, to a medium. And now that's not going to be quite as big. If you want it to be a little smaller, you can do a medium thin. And if you wanted to, you could add a label. The label just simply puts the price over in the right side of your chart. I choose to just leave that at the default usually. Now come on down, you see where it says function. Normally down in this area, this is where you could change the functions a little bit here. But in this particular case, you notice that the value says and bowl bars. This is what Trade Navigator calls a linked input. And so to adjust this, we actually have to go to the linked input section. So just come right over to the same section where you saw the price panel, and you're going to see an item that says linked inputs. If you click that, looky here over on the right side, there's your Bollinger bars, your standard deviations. This gets all of the inputs to be the same. So let's change it from 18 to 20. And there's your default settings that we're used to seeing. Trade Navigator, for some reason, defaults to an 18 and 20, but we're going to default to a 20 and 2 now. So that sets that up correctly. So what we've done is we've changed the moving average, and now we've changed the linked inputs. Now let's go down back to the price panel here, and let's change the upper band. If you want to change the upper band, again, you can come to the right portion here and change the appearance. We could change the color if you wanted to. And what I like to do is I change the width. Instead of being a dashed line, I change it to a medium or even a medium thick line. That way I can see it really clearly. And I like that. It makes me a little happier whenever I'm looking at this. Everything else is the same. And since those are linked inputs, those settings are going to be the same as well. Those are changed now to 20 and 2. Now, if you want to change the lower band, you simply click on the lower band here. And let's just change the color so that makes a little match there. And we'll change this to be a medium thick line. And now we've changed all of our settings on here. So if I click OK, boom, there it is, all set up on your chart. There's your Bollinger Bands. A little bit maybe more like you're used to looking at it. Now you can customize those even further. Let's edit chart settings again. Again, right-click, edit chart settings. And you could, for example, change the moving average to be a pink color. And if you like to look at it that way, then you could do it so however you choose to have it presented. Anyway, that's how you change those settings. Now, the next one that's really valuable is to set this up as a template. So let me show you how to do that really fast. Once you have your chart set up, come up to the upper portion of your screen, and you see where it says templates? Click on that and go down to the one that says manage chart templates. And if you click on this, you've got the opportunity to save as a new chart template. So let's do a new, and when we do new, you can type in here JDubs BB for Bollinger Bands and click OK, and boom, there it is. There's a new JDub BB, and now that's going to be a template. Now, the way Trade Navigator does this that's really easy to work with is you just move these templates around. You see I've got my TradeSmart template set up. Well, you can move this one in here. And let's say I had JWBB as the number 1 after default. That's also going to be hotkey number 1 on your keypad. So all you need to do is press 1. Now watch what happens here. I'm going to change to a different template. And now watch, I'm going to press number 1 and boom, there's my Bollinger Bands. It just pops up. All I did was press the 1 key. And so that's how you do that. You set the template up and you can just keep going back to it over and over. You also can click on the template menu and come down to a template if you choose to do that as well. That's another way you can do that. But I like to use the hotkeys. I think it works really well and it's really fast. So that's how you set it up here in Trade Navigator. And hopefully this has been beneficial for you and it makes a whole lot of sense.
This is going to bring us to the end of class number 2, so I hope you've learned a lot about %B and the bandwidth indicators. Number 1, you should understand how they're formulated now. You have an idea of how they're calculated. Also, you start to see some of the signals that we get from them. So how do you apply it? Well, that's where your homework's going to come in. You need to start taking some of these principles and looking at them. I'm still kind of laying out all the pieces of the puzzle, but there's a lot you can start just looking at on your own to get an idea of how you can start to apply this. So here's your homework. Go set your indicators up in your charting software. Whatever charting software you're using, you need to get that set up so you've got access to those. I really encourage you to save it to a template as well so you can come back to it and you can reference it quickly. Next, go look back at several charts and compare what the Bollinger Bands are doing with the %B and the bandwidth. And the best way to get comfortable with this is to just go look at it. Maybe do some back testing with it. That's my next point here. Try doing some back testing, back trading with these new tools. The best way to get comfortable is to just use them over and over to see the visual so you start to really lock in what those visual pictures are going to look like. And in the next class, we're going to come back behind this here. I'm going to start showing you how candlesticks work, how some of the patterns work, and some of the additional tools that maybe you've already been familiar with, but now we're putting it inside that framework of the Bollinger Bands.